Let's talk a little bit about the economic speedometers for February 2025. So you can see on this screen, you've got November of 2024, which was the last time we got together on these speedometers. And now you got February 2025. There's really only been two changes here, the U.S. economic outlook and energy costs. We're going to hit the U.S. economic outlook first. Now, there has been improvement, and some of the reasons they're improving are because job growth still remains solid. One of the reasons the Fed is not getting the clear signal to reduce rates is because the job growth is still there. It's not going down as fast as he would anticipate or would like to see it in order to lower rates. The other factor here is wage growth is very steady. It's helping boost the U.S. economic outlook right now. Now, on top of that, from an inflation standpoint, though there are still concerns, it's moving in the right direction. Again, not as fast as Powell would like to see it, but you got to really look at it kind of like losing weight. If you're trying to lose weight, your weight doesn't go down on a straight diagonal to the point where you want it to go. What you'll see is it looks more like a bit of a bull market or a bear market where it goes down a little bit, goes up a little bit, goes down more, goes up a little bit, goes down more. But the key is that it's going down over time, and that's what's happening with inflation right now. Then you look at consumer spending. It continues to support the economy. And remember that 70% of the economy is the consumer. So if people are still feeling very good about their income, if the job growth is still there, that's going to help continue to spur on the economy. Then you've got corporate earnings, which are really reflecting strength. And to that end, you got to think about what the current administration has made very clear, that they are a business-friendly administration. They want their policies and their priorities to be businesses. And that bodes well for corporate earnings and reflecting strength, because part of the corporate earnings is based on where the companies believe their profits are going to be in the future, where their revenues are going to be in the future. And based on the administration's policies, they're seeing some pretty good trajectory out there right now. Now let's switch over to the energy costs. Again, this is another dial that has improved, and with it, still in the neutral area, but it's getting closer to green. So energy costs. First of all, the shifting policies, supply dynamics, and geopolitical factors are certainly playing a part in the energy cost. We all know that President Trump, during the elections, was running on a platform of bringing energy dominance back to the United States. Second, in a recent speech at Davos, President Trump directly called out Saudi Arabia and OPEC to bring down oil prices. And really, it is kind of in their best interest because they're competing against Russia. So bringing oil prices down when Russia really cannot afford to do that is actually going to bode well for them as well as the United States. Now, what does this mean for investors? Well, you may see some volatility that's relative to anything in the energy sector. Prices aren't likely to spike dramatically. That's just not something that happened a lot in the first administration. And lower energy prices could be helpful on the inflationary front. And it certainly is going to help drive economic momentum. I mean, think about it. All businesses, and to some degree families, run on some sort of energy. And when energy costs get lower, what happens? Well, at the end of the day, we have more money to spend.